No worries. So I'm Bill Haddad. I've literally been hosting and helping Marty with these events. It's got to be 13, 14 years, 15 years, something like that. I remember that event in Palo Alto. It's kind of interesting, we did a tag team with a San Fran event, and both went well. And it is ironic who showed up at that initial Bitcoin.
I wanted to say also Bradley Rotter was there as well, which I forgot. Bradley Rotter, who's done very well with Bitcoin, and now he's in Austin, Texas. So anyway.
Yeah, no. Look, anybody in at that point has done well, right? You could not. Very happy again for Ivy Family Office to think of me and to organize another great event. My name is Bill Haddad. Again, I'm with the large law firm Venable. I'm based here in New York. I head up the SPAC practice for Venable, and I was just thinking the other day, I've been representing SPACs and doing SPAC deals all the way back to 2005. As one client said to me a few months ago, he said, "Bill, you were involved in this way before it became cool." And it's definitely cool now. It's definitely mainstream. It is, and really for several years has definitely not been a fringe product anymore. People tend to forget that even leading up into the crisis in 2009-10, SPAC IPOs were approaching, I don't know, I'm going to say 30% of the market, but a very significant part of the market even then. My practice is focused largely on securities, part of which is SPACs, representing all kinds of public companies, both foreign and domestic, and have actually done a lot of work with China. My first SPACs were Chinese focused, and now doing much more on the healthcare biotech front, and very active in SPACs. Getting a lot of inbounds now, even from other partners at Venable, as well as my own client base, both the IPOs and the business combinations. I've done many of those as well. So it's a great area. It's become much more diverse in terms of type of companies that are approaching this, and frankly, the type of deal teams and how they're structuring the SPAC themselves. I would just add that the product has evolved. Part of the reason everybody reads about it every day is the product has evolved wonderfully in the 16 years I've been involved in terms of the terms and answering questions or weaknesses. And that's why now you see so many deals. I think it's that combined with the much higher gene pool participating, some of whom we have on this panel. We have a great panel with, actually, for a product that's been around that long, we have decades of experience with people on the panel. So with that, I'll just go to the folks who are on the panel and let them introduce themselves. I see them, so I'll start with Steve Fletcher.
Hey, everybody. Nice to meet you virtually. As Bill said, my name is Steve Fletcher. My background is that I was an investment banker for quite a while. And then 3 years ago, I started a firm called Explorer to sponsor a series of SPACs, each one in partnership with A-plus caliber former public company executives. We've now sponsored 5 SPAC IPOs and have more in the pipeline, and looking forward to being on the panel here. You're on mute, Bill.
I also saw Chris Winiarz. Maybe he can introduce himself. There he is.
Hi, Chris here. I serve as the Chief Investment Officer for Lakeview Capital Management, which is a single family office in Chicago. We serve one family. We have a team of 5. We're global. We touch on all asset classes, but we tend to focus on inefficiencies, which has led us to SPACs. And we've participated in a handful at the sponsor risk equity level. But it was a research project for the last handful of years, and I've now participated in a few. So hopefully bringing a little bit of the family office perspective to it.
Great. Is Eric Ball on as well?
Yes, I am, Bill. Thanks.
Hey, there you are.
Hi, everybody. I'm Eric. I spent 28 years as a public company finance executive, 11 of those years as treasurer at Oracle. Then I spent a year as CFO of a startup that became an AI unicorn. And for the last 5 years, I've managed my own early stage venture capital firm, Impact Venture Capital here in Silicon Valley, that invests in early stage applied AI startups and emphasizes co-investment with corporate venture arms. I have not made a career out of SPACs. I'm relatively new to the SPAC world. I was approached by a group that kind of like what Steve described that he does. I was approached by a group that acts as a SPAC sponsor. They call themselves SPAC partners. They've done 12 SPACs. They recruited me and another local tech executive, Brent Kalinikos, who'd been CFO at Uber, to be the tech guys for a new SPAC with a tech thesis. So my role in this larger SPAC team is really to focus on the M&A, the target identification and diligence for the company that we will bring in and de-SPAC the transaction with. So I'm relatively newer to the SPAC world, helping identify appropriate targets for a particular SPAC. And I'm doing that as sort of a sideline to my day job, which is managing an early stage venture firm.
Sounds great. And is Irv Schlussel? I think, yeah, the other.
Irv was logged in earlier, but he's putting out a fire right now. He should have logged in the next half hour.
Okay, wonderful. No problem. And the only other, is that it for this panel, Mark? I know there was another name.
It was Clay Whitehead, but I'm still waiting to hear back from him.
Okay, no worries. Okay, so that's fine. We've got more than enough firepower here. I thought the group kind of wondered about, some of the people on this may be very, very well schooled in SPACs, some may not. So I thought maybe we could have the panelists, so maybe we'll start with Steve. Okay, give a little walkthrough from a high level on some of the key aspects of a SPAC terms, and then we can all kind of weigh in. I thought, Steve, you could be a good guy to start with that. That's okay.
Bill, I'd be happy to.
Great.
And maybe I'll just give a quick description of what I'll call SPAC 101 for the real novices, and then I can go into some more detail and SPAC 101.5 or something like that. So a SPAC, as I'm sure everybody has now heard in the Wall Street Journal or whatever your financial paper of choice is a blind pool of capital that is raised in the public markets. And the blind pool is funded by various investors. It goes into this public vehicle. It is a liquid investment, and the SPAC managers then go out, try and find a single private company to take public, and they would structure a merger transaction with that private company where the private company gets merged into the public company shell and becomes a public company in the process. And so that's the, at a very high level, that's the structure. One of the questions people often ask is, well, why would you invest in a blind pool? And it's very similar to investing in many other types of blind pools, whether it's private equity, whether it's venture, whether it's hedge fund or anything else, where the investors are choosing to back company management in this investment, but as opposed to a venture investment or a hedge fund investment or any other typical type of investment, the beauty from an investor perspective of a SPAC is that the people who invest at IPO or who buy the stock in the aftermarket have the option to look at the private company transaction that the sponsor brings to those investors and say either, yes, I like this deal and I want to hold my stock, or no, I don't like this deal and I'm going to redeem my stock and get back the money that I originally invested. So I'll stop there as sort of the, Bill, initial intro. We'll call that SPAC 101. And if we want to go to 102, happy to talk about more intricacies.
That sounds good. I think that, one thing that has changed and evolved that we were speaking about regarding SPACs is who's taking part in it, who's a player, and in what role can they be a player. So, you know, for example, of course, if you're a private equity guy or a C-suite M&A person, and you have the requisite deal flow, you can participate as a sponsor. And then, you know, obviously you have to have the risk capital because it does cost several $1 million to put a SPAC together. But, you know, I think now what's evolved and is that a lot of folks are playing a part, and from a more varied perspective. Maybe we have Chris Winiarz. We were talking about this. He's with a family office, like you said, and he did, as he'll walk you through, he did really an excellent in-depth look at how it would be best for his firm to play a role in SPACs. And I think if he kind of walks through some of the analysis, we can touch on the fact that, you know, one can be a sponsor, like I described. One could be a passive participant or relatively passive participant in the risk capital and let other folks like Eric Ball, Steve Fletcher, you know, run and do the SPAC, kind of carry out the SPAC itself. There's other roles where people can just buy in the IPO. I mean, there's a mafia hedge fund, hedge fund mafia over the last 10, 15 years has done the lion's share of the buying in IPOs, a lot of 5 and 10% orders. And then, of course, now that the PIPE, which is something that takes place on the business combination, the merger, which is really what's helped this product evolve tremendously, because it's taken out all the risk and all the uncertainty for targets and how much money they'll get. And so you can participate at the PIPE level. I thought Chris could maybe walk through those categories a little bit and see how he analyzed it for his.
Hey, Bill, just real quick, Irv just joined, so.
Oh, great. Hey, Irv. Irv, would you like to introduce yourself?
Sure. My name is Irv Schlussel. I manage a single family office called the Diamond Family Office, originally out of Ohio, based in South Florida. Prior to that, I managed a family office called Inglesey Capital for the past 6 years. My approach to SPACs is largely as a public market participant and arbitrageur. We've looked at sponsor equity deals in the past and have a pretty decent sense of the ecosystem, but really kind of almost look at it as a yield plus option vehicle.
Yeah, and I can take over from there because I think that's a little great segue there, Irv. So on our family office side as well, a handful of years ago, board member came to me and said, "Hey, Chris, why don't you launch a SPAC?" And I literally said, "What's a SPAC?" And so we spent some time out there with the top 5 or 10 investment banks, just kind of walking through the process, understanding the pros and cons and of the transaction and where we could or could not participate. And we ultimately kind of outlined it in terms of risk reward, which is everything we do here internally. And we segmented it really into 3 different participant levels. One is at the equity risk level. So as a sponsor, where you are receiving promote shares in exchange for the capital that you're putting up. Everyone's cost basis is slightly different depending on how these things are structured, but you could loosely think of your cost basis somewhere around $1.50. And so if you're able to execute upon a deal, you receive these founder shares convert to common, and you can make, let's call it 5, 6, 7x your money, depending on the quality of the deal and where the stock is ultimately trading. That's great, but there's binary risk to that, because if a deal does not get executed, all your equity risk capital that is put up at the operating company level is effectively spent, and you're left with nothing. So binary risk, and there can be 100% permanent loss of capital. That may or may not work with some groups. And so the next way to participate, as Bill had alluded to, is at the IPO. And there's a little bit of I think, as you called the hedge fund mafia. I think historically, and this is somewhat evolving, but historically there's 50 different multi-strat hedge funds that are effectively participating at the IPO to strip the warrant and effectively make money off the volatility, right? Their downside is protected because they can vote and take their money out of trust if they don't like the deal, but they can strip that warrant and sell that in exchange for whatever the going rate is. And effectively, you can have downside protection. But with the exception of the last year when these things were trading at astronomical values, 1.5 times book value of cash and trust. With that exception, you're really just making money off the volatility of these things. And so that's a nice, kind of mid to high single digits that you could earn. But typically these multi-strat firms would use some version of leverage on the back end to enhance their economics. So you're trading downside protection for leverage risk that you're taking on and reducing your vol. And then the last piece that we thought we could partake in is really on the back end upon a business combination where typically, not all the time, but typically there's a PIPE transaction being raised alongside. There you have a better sense of, what the company is, the ultimate target. You have a better sense of the financials, and you can place your own projections on that and effectively build your own discounted cash flow model on what you think that is worth and buy into a company at hopefully a discount to its valuation. And so that's great. You can, buy a company and continue to own that one in the public markets, but it's also somewhat challenging to overcome the amount of dilution that is occurring. So we thought, we can take binary risk, but have a 4 or 5x upside, 100% downside. We could have our downside limited at the IPO, but we'd probably have to take on some leverage to meet our return targets. Or we could just buy a company in the business combination at the PIPE transaction, and if we like the company, great, we'll continue to own it. But it was difficult for us to meet our valuation standards. So we ended up partaking early on at the sponsor risk equity level, and really coming in effectively as a co-GP with several sponsors. And that presents its own set of challenges. But we really started to walk through it in terms of risk and return and where we wanted to play. But let me pause there, Bill. I don't know, Irv, it sounds like you play in a different part of the market as well. So I'd love to hear your thought process and how you led to it.
Well, first of all, I'll start by saying that, we've evaluated these sponsor opportunities and probably regret passing on some, let's say 2 to 3 years ago. At this point, I think sponsor equity is fairly risky unless you're in the top tier of sponsors. You do lose 100% of capital. And I am a little bit curious how you structured your deals. So, some guys come in on a senior level, but part of the problem is, let's say you're providing sponsor equity and you're kind of a preferred seniority. If you don't effectively control the keys to the transaction, you might not have the same motivations to get a deal done, because if the name sponsor, let's say you're the money guy, the name sponsor might want to proceed and get a best deal possible and wait till the last minute, whereas you're willing to forfeit economics just to recoup your principal, given your level of seniority. So there might be some disincentives with respect to sponsor equity unless you really structure that agreement well. But so that's an aside. In terms of my broader approach, I buy SPACs for yield plus option. So I've been very active up until say 6-7 months ago when it kind of got crazy, and then I kind of held on to my portfolio and was lucky enough to reduce pretty dramatically at the beginning of the year when things got a little wild. Now we're starting to nibble a little bit. You're starting to see some SPACs that offer, let's say 2 to 3%, annualized. You can even get maybe 4 or 5 once in a while if you're sitting on the bid. I think that opportunity is going to increase. I think there will likely, depending on the broader beta market, be a greater sell-off just given the amount of supply. It's a supply, demand, and natural owner. And you might really have SPACs get to a 5 to 7% yield, at which point I think you're supposed to kind of wave them in with moderate leverage and keep adding more leverage as they get wider, within reason. So that's kind of how I'm thinking about it, but love to hear about structuring as a family office sponsor equity, because I think as things stand today, it's probably a lot harder to get a good deal. And in general, sponsor equity is going to be a lot more pressured once I think the pipes have kind of started to go away. The pipes were looking to the equity market that was putting really high numbers on it and saying, okay, I have a whole period of 45 days or 90 days until registration, I'm willing to take that risk. But I think one of the reasons you've seen a whole slowdown in the SPAC ecosystem is because the pipes are starting to mitigate because the greater fool is gone.
And Irv, why do you think the risk profile has changed? Is it the quantity of SPACs and therefore, the simple mathematical fact that the likelihood if you don't get a deal done has gone up, or
completely?
When you say
there's
more risk, how do you characterize that?
No, so sorry to interject. There's more shells out there, and the value of the SPAC, absent, the highest quality of sponsor, is now boiled down to really a shell plus whatever capital stays in. So if you look at what's implied by the market in terms of what's going to stay in, it's kind of interesting to look at the announced deals, most of which came with PIPE. So they're going to meet the minimum cash. The transaction is secured, but the share price is trading well below that $10 price. So that's saying something about what the hedge fund traditional SPAC holder is going to be doing. They're going to be redeeming. So the only value proposition other than, differentiated sponsor quality, which is there on some level in some SPACs, but in a much smaller quantity as a percentage of the whole, the only value other than, good sponsor value add is the cash, and the cash is gone. So now it's shell plus sponsored. So I think it's kind of tougher.
And Chris, just to follow up on a couple of Irv's comments, do you feel that it's getting harder to structure how you're entering into these? You envision structuring it differently, or kind of how are you thinking of that?
Yeah, we haven't really changed our structure per se, but it is definitely getting more difficult to partner with the right groups. And what I mean by that is, for us, and particularly at the equity risk level, it's all about alignment of interest. And so we've narrowed it down and we've said, we're only going to partner with groups that are putting up at least 50% of the equity risk capital themselves, which that alone narrows the universe down quite a bit. We then look for other pieces of alignment, whether it is, where is that capital coming from? Is it coming from their own pocket? Is it coming from their maybe a fund that they run, their LPs capital? Who's receiving the promote shares? What's the allocation of those promote shares? We look at things like forward purchase agreement, which we think is a nice indication of some commitment to the quality of the deal. And that's all before we even look at the quality of the sponsor themselves and have they executed deals previously within their area of expertise, and what is their sourcing mechanism. So I think when you look at that wide universe of sponsors out there and whittle it down to the groups that we believe have strong alignment, it's few and far between. I mean, we've probably looked at 150 of these and only done 6. And so it is really difficult. And when you think of the dollars that you can actually deploy here, it's also pretty limited as well.
Right.
So on average, if you call it a 200 million IPO and they got to put up 3% equity, 3.5% equity risk capital, call it $6 just to make it even. And we've already said they need to take 3 of it themselves. That only leaves 3 for us. And for the most part, we're not always getting that full, 49% of the deal. We're only getting a portion of that as well, because they have their own, kind of families coming in alongside, putting up some personal capital too. So I think just the quality of the sponsor, it's definitely moved in a certain direction. Alignment are things that we're looking for, and just capacity. And that's all pretty tough to find. So we haven't really changed the structure of our deals. There's plenty of groups out there that have structured them where your cost basis goes through the roof, and effectively they take a lion's share of the waterfall. We've seen 100 of those. And we've just decided we don't want to partner with those groups where our cost basis is marketably different from the rest of the management team. So the most recent one we did, we have the exact same waterfall as the management team, same cost basis. And that's, you know, we're typically there within 5 or 10% of them, just based on how economics get split. But the groups where their cost basis is 1 and they're trying to syndicate it at $3, that's just not the right fit for us. And there's plenty of those out there.
Well, yeah, I mean, the alignment of interest is critical. You know, just to emphasize what I think Irv said it before, is obviously the real downside of SPACs is if you don't get a deal done in the 24-month time period, which is a typical time period, that's the downside. That risk capital is lost. So you want to know that everybody's got their hair on fire and their interests are aligned to make sure a deal gets done. You know, the one improvement in the product is people can extend the time period, which has been fantastic. It does cost money typically in most cases. So you want to be really careful about alignment of interest. I couldn't agree more. And I guess one question I have, and if other folks have a question, feel free to raise their hand, but is on returns. So like Irv and Chris, are you seeing, there are, as you said, I think when you said, there are single digit returns. There's different ways to make money here, and it seems like the returns are there. It's just, you know, you guys have opted to pick a certain area. Chris, I guess the risk capital offers a bigger ultimate return. Maybe that's what's interesting for you. And Irv, I guess between risk and reward, you like buying in the open market or the IPO. Is that fair? Like, how do you, can you make money in all the different ways, Chris, sort of, would you say?
We only partake in the equity risk capital. And so for us, our math and our waterfall, we think is pretty conservative, but we basically write off the warrants and assume the stock doesn't trade anywhere. That sure, there's time value and money to the warrants, but we ascribe 0 value to the warrants we receive, which I totally recognize is overly conservative. We also assume that dilution forces that stock to trade down to $8. And so then we basically bake in what is our cost basis versus an exit value of $8. And we're looking for 4 to 1 kind of upside there at a minimum. And that's relative to 4x upside for 1x downside. And that gets us to a level of comfort. Now, again, that's only on a single deal. And since they're binary, part of our mantra as well is we need a portfolio of these. So that's why we're trying to build out a collection of them, because any one deal, there's a chance it doesn't get done. That's loosely how we think about risk return and vol.
Steve, did you have anything you wanted to add kind of in this area about how, I mean, you're playing in a certain niche role, right? Really as a sponsor. So
yeah, that's exactly right. So we provide our risk capital. We do partner with executives, sorry about that, on the risk capital, but we've got a slightly different equation than these guys in that we are the sponsor and then we're partnering with the management teams to do it. So, we provide with our firm, our platform, an institutionalized approach to the SPAC market more broadly. And for our investors, the people that have invested in Explorer, we provide a diversification across multiple SPACs. And so Chris and Irv talked extensively about the risk of losing your capital when you invest in a single sponsor entity. which is a very real risk. And particularly with hundreds of SPACs out there now, it's a much more real risk today than it was a couple of years ago when there were a couple of dozen SPACs searching. And we provide our investors with a diversified approach to that. And so it's, you know, it's very different than a single transaction approach.
Yeah, that's a big value add because of the binary nature of an individual SPAC.
Exactly.
Yeah, that's a very important point. One question I always get asked is why would a target company? I mean, we may have people, family offices that are invested in companies that could be a viable target company for a SPAC. And I thought Steve would be a great guy to kind of walk us through a little bit. Why would a target company go public through a SPAC or a de-SPAC business combination rather than what we're all familiar with as the more traditional IPO process?
Yeah,
Bill,
excellent question. So people have probably read about some of the structural advantages of a SPAC, which are material, right? It's much faster than a traditional IPO. It's got potentially substantial secondary liquidity for the existing shareholders. You've got more security on price. You've got a bunch of very structural benefits. To me, though, the main reason to do a SPAC rather than a traditional IPO is that you are getting a partner to help you as the company succeed as a public company. And when I say we partner with A+ caliber former public company CEOs, the idea is that being a public company is hard. And when you've never been the CEO of a public company before, and Goldman Sachs or Morgan Stanley or JP Morgan does a great job on your IPO, and they price the deal and the confetti falls to the floor, and then somebody's got to sweep up the confetti the next day and say, how do we operate this business? And I think that rather than focusing on price or what's the sponsor promote, I think that any company that looks to partner with a SPAC should be thinking first, second, and third, who is my partner and what are they going to get me and how are they going to help me? Are they going to help me with customers? Are they going to help me with strategy? Are they going to help me with managing the street? Are they going to help me with sales and marketing? What is it that they're going to do to help me, and what kind of history do they have to prove that they can do that?
Could I add on to that?
Absolutely.
Sorry, Eric, you cannot. Nope.
That's what I thought you'd say, Steve.
Yeah, exactly.
No, I mean, I think that Steve makes a great distinction between going public and being public. And investment bankers help you go public, and that's part of the equation. But a SPAC sponsor and the team can help you go public in a more effective way, and also prepare you to be public. And I think, the fact that it's technically a merger rather than an IPO makes it faster. You can get a definitive agreement in 20 or 30 days. You can complete the business combination in 60 or 75 days. That's just faster than a traditional IPO. You avoid the risk of a failed IPO or worrying about the market because the shell company's already done the IPO. Now you're a merger, and that mitigates some risk about whether the markets will cooperate. And you can control the timing a little bit better in terms of raising your profile, educating the market, attracting analyst coverage. That's all part of going public, but the preparation to be public is really critical as well. And I think that a lot of that, I'm a former finance executive, a lot of that falls to the finance function. I like to say that when you tell a company that it can go public faster via a SPAC, the CEO gets excited and the CFO gets scared. And I think that working through that and helping the finance team be ready for the burdens of being public can be a real value add for a SPAC team.
Yeah, that's great. Steve, what do you think, and you may have mentioned it, but I agree with that. And the partnership is a key element. And frankly, with the fact that there were more SPACs, that's only going to be a bigger differentiator as people decide which SPAC to speak with it. You know, it's important to remember the way the market has evolved, that it's probably only in the last 3 years that, you know, a SPAC who's looking for a deal will approach a target and the target will say, yeah, I'm talking to other SPACs. I mean, it's about 3 years. I mean, certainly 2 years ago that was happening. I don't know if it's 3.5, but it's a relatively recent phenomenon. But now, with how many deals have gone public in the last 6 to 9 months, it's going to become a much more common situation. And so that's a big point. But Steve, I want to ask you, what do you think of another very positive point about doing SPACs is that there's a little more structural flexibility in terms of the consideration, that you can have earnouts, you can have milestones, and the pricing to the target is not so as now with a regular IPO, because with a regular IPO, a lot of times, you know, it really comes down to where's the world that week, that night you price. And that's one thing I hear targets say that they really do like about the SPAC transaction.
Yeah, that's absolutely right. So, but on 2 points. So one, almost every company that we talk to now, and I certainly prefer the term partner company to target company, almost every company that we talk to now hires an investment bank on the sell side. And, you know, it's interesting. And as somebody who was a banker for 20 plus years, I can tell you that, you know, one thing bankers are very good at is getting buyers to raise their price. However, that's not really what's important here, because this is a going public transaction, not a sales transaction. And so I think the street is coming around to to that pretty quickly. But you're right completely on on the other point that structurally earnouts are a big part of the SPAC product, and it's really, they're typically structured in a way that's a win-win for the investors and for the partner company, because they're typically structured at to be achieved at stock prices, as opposed to when it's a private equity firm or a strategic that's buying a company and they structure it based on revenues or EBITDA or something like that. SPAC earnouts are very typically predicated on stock price. And so if the partner company's stock price hits $15 or $20 or some number that is a material gain for the investors, then the partner company shareholders get more stock. And it's a win-win, right? If the investors are up 50 or 100%, are they happy to see the partner company owners get more equity? Yeah, they should be.
That's great. That's a big that's a big point. I think the other interesting thing is you get a lot of firepower, like you just said. You're exactly right that more and more now it happens almost every deal. But again, that's a newer fact that all these targets themselves bring their own bank. It brings more firepower on the raise, on the pipe, and I think it's a very, very interesting point. What do you think? I'll loop Eric back in. Maybe he can talk to this along with the rest of the gang. Is what considerations, Eric, in your mind, are you guys formulating as to what is a good partner company? I'll steal the line from Steve. What's a good partner?
I like that too. I'm going to plagiarize.
I'm going to steal that, Steve. That's gone now.
I'll take credit for that, but partner is probably not the world's most original term. So go with it.
Well, it's less confrontational than target, which implies we're shooting at the folks we're trying to collaborate with. So I like the term. So, I was recruited by a SPAC sponsor to chair the board of this particular SPAC and cast a net for partner companies. And one of the things that persuaded me to join this particular sponsor team was that it was smaller. Like there are a lot of really big SPACs out there. And the economics, if the SPAC is too big, then the economics require that they partner with a unicorn. And at this point, there are almost as many SPACs as there are unicorns. Size, I think, is a consideration for us. We did a relatively smaller SPAC so that we would have the ability to look at half unicorns, sort of 500 million to $1 billion size partner companies. But we could also use pipes to look at the bigger companies too. So we could choose to try to elbow our way into the big transactions, but we had the option of hanging out in the smaller space where there's sort of less competition. And I thought that made sense because the economics for our particular SPAC work at a smaller number. So one consideration in terms of what's a good partner company is the appropriate size. And we purposefully went a little bit smaller, but that makes us more reliant on pipes if we do go after a big target. Another consideration is just fitting the advertised thesis. I was recruited as a tech guy, different SPACs seem to be forgiven for being a little bit more vague in their thesis than I'm allowed to be in my tech venture investing. But we are still a tech oriented SPAC, and so we want somebody that really fits that thesis. A third consideration I alluded to earlier, which is we look for a company that's not just ready to go public, but to be public. And we look a lot at the finance function. Are they ready? Do they have the audited financials? Do they have a CFO who knows how to take a company public and knows what it means to be public? And we think that can be an underappreciated element where, we certainly look at the CEO and the rest of the team, but we really, in our diligence, we focus a little bit more on the finance function than we think may be the norm elsewhere. And the last thing I think I'll mention is, we look for targets that don't just have the ability to support evaluation, but also that it's not too complicated, that the company makes sense, not just in reality, but also optically. We don't want the only investors who understand the potential of the company to need a PhD in engineering or machine learning. So we think it helps if the business model doesn't require the level of deep expertise to appreciate that we might apply in the venture world, but it's sort of a more obviously attractive partner. So I'd say those four considerations are kind of high on my list.
Eric, when you say smaller SPAC, how are you sizing? What in your mind is small? I mean, it's always relative to the audience.
Well, sure. I mean, a rule of thumb that a lot of people seem to use is that in order for the economics to work efficiently, you want the SPAC target to be at least 3 or 4 times the size of the initial shell company IPO. So, if you want to acquire a unicorn, then you probably need to have at least, $250 million shell IPO SPAC. I mean, it's a very loose rule of thumb, but that what seems to make the economics work. Our particular SPAC, the Archimedes tech SPAC, we did a 133 million IPO, shell company IPO. And so 3 to 4x that is only, 400 or 500 million. And so the economics can work at that relatively smaller size, which really increases. I mean, there are multiples more $500 million companies than there are billion-dollar companies. So we feel like we can cast a much wider net that way. And if we do end up at a big partner, I keep trying to say target, but I really like partner. If we end up at a bigger partner, we'll just use the pipe to get up to that size. And that may be a little more challenging today than it was 6 months ago, but I think good transactions can still get a pipe. So by doing a $133 million IPO, we feel like our target range is anything 500 million and up, whereas many of the other SPACs, we feel like it's hard to make the economics work for a partner that's less than $1 billion valuation.
That's great, and that makes a lot of sense. Yeah, one question I mentioned earlier, my first SPACs I worked on were foreign focused SPACs, happened to be China. You know, this is circa 05, 06. Irv, you're investing in the IPOs, so you're seeing a lot of them and then investing in some portion of them. Do you see them becoming a little more internationally focused? Yes, or how are you seeing that come like? Where are the geographically, are they focused in certain areas? My experience right now, I think the vast majority are focused in the US. They can go anywhere, but to what extent are you seeing an internationalization?
I think we're starting to see more EM. I mean, look, SPACs are all about the ability to sell. So people want something that has a lot of upside. So I wouldn't say it's like developed Europe, although there's been some of that, but I think there's been many more EM, China. I think Goldman has one with, former Goldman or its current Goldman PE guy doing a China SPAC. I was on the phone with EM private equity sponsor, and she's looking, to bring us back. So I think there is more and more of an appetite for that sort of thing. And it is a little differentiated because the supply right now is mostly tech oriented. So that's a differentiated area, but it still has, the sexiness and appeal that will draw in investors of all sorts.
Got it.
Chris, I would agree with that. Yeah, I mean, our most recent S1 that's been filed, it's still confidential, but that'll be targeting India, where we just don't see a lot of current appetite. And given the structure of the capital markets in India, it's not that deep in terms of public markets players. So it might be a little easier to support an IPO here with kind of US institutional investors.
And is that size-wise, is that a big, you would that be on the small side because it's an emerging market? How are they, or do they have the right context where they can find a big deal?
Yeah, I mean, I would say it's not that small, but it's definitely not one of the largest ones out there.
Oh, yeah, sure.
Yeah.
It kind of feels similar to ETFs, let's say 5 or 10 years ago, where you want to create the ETF that no one else has because that's what will sell.
Right. I mean, I will say that, I mean, given all that, I mean, if you looked at the percentage of SPACs that have been stood up and raised, there's, it's a clear minority that are focused internationally at all. Like I would, like for China, for example, I would say in terms of ones that have been raised, it can't be more than about 15, maybe, give or take, that are focused on China out of what I think is about 450 chasing a deal. Yeah. So there's a lot of room if you think those geographies have good targets, I think there's a lot of room to go there. Steve, any thoughts on geography? Have yours been US focused or?
Sorry, on mute. I was talking to myself there. It was very impressive. Our 5 so far, Bill, have been, I would say, geographically agnostic, although with a US bent to them. We have a number more in the pipeline that we are working on now, one of which will be Israel focused and one of which will be Southeast Asia focused. And so I do think everybody here is right that the US market is probably overshopped and the global market is probably undershopped. And so I think the opportunity to go after partner companies around the world is one that's very appealing. I also think it's worth noting that in a globally competitive stock exchange market, the NYSE and NASDAQ have seen an explosion in listings of newly public companies via SPACs. And as the other global exchanges have watched that, Amsterdam is trying to get in on the show, and they've had a few SPACs listed. And London, Singapore, Hong Kong are all exploring how can they attract SPACs to their exchanges as well. So I think we'll see US SPACs looking globally, And I also think that these global exchanges have woken up to the idea that the IPO market on a standalone basis may well be too narrow, and that SPACs offer a lot of value to their partner companies and to the investor community, and are want to adopt them as well.
I mean, that makes a lot of sense. Marty, I think we've got much more we could talk about. We've got about 10 minutes left, I think, right, Marty? Should we try to address some questions? How do you suggest we do that?
Yeah, hey, Bill, you've got about 15 minutes left. So,
Oh, okay.
yeah, I think you should address questions. But, you know, again, so I get calls, you know, routinely from Europe and Asia about SPAC, which is unusual because up until 2 months ago, I wasn't. And then all of a sudden, the last couple of months, I've been getting lots of phone calls. I'm not sure if that's because their targets or their markets are changing or what, which is why I asked that question about SPACs.
Yeah.
But, you know, obviously I'd like to know more. And I'd also like to know about, you know, somebody else, and actually it was somebody from Asia called me up and said, you know, the volume of unicorns being created, the velocity is increasing, right? Obviously there's inflation, but also there's, you know, people are putting out great products. So that's why I was, you know, so it seems to me that the unicorns are kind of outstripping the ability for them to exit, right? And that's why, you know, I was wondering about, you know, the SPAC approach and nature in that marketplace, right? Even if there's a lull right now in the US, it seems it still doesn't stop new companies from being created that have fantastic results. And so my, you know, you guys are a bunch of philosophers in the SPAC space. I was hoping to get some conjecture or thoughts about that, because certainly in the current regime, there's not going to be more IPOs happening.
Yeah, I mean, well, I'll leave it to the panel. I would say that, you know, look, the market, you know, right before Easter, it kind of quieted down, obviously, but it couldn't keep going like it was going to go. I think that it'll come back. I think ultimately it will open up. Usually in these situations, the biggest salve is de-SPACs happening, the closings, money freeing up, people redeeming. It gets money back in the system to do new IPOs. And you know, I think just deal signing will help too. You know, as far as geography, I do think I think as the panelist said, I think that there are opportunities emerging overseas, maybe because of, you know, a lack of depth. I think someone mentioned an India focused SPAC because maybe a lack of depth in the home country capital markets, and they're seeing how fluid and how much money can get raised in the US. I think, I mean, put SPACs aside, there's just been a ton of money raised. Follow-ons are not stopping. You know, in the US, in these markets, you have a certain amount of liquidity. I mean, not to be too simple about it, you can raise money. I have clients, they get called up by family offices or funds. If they've got enough liquidity, people will do overnights at a certain discount all day long. I would say that. You know, I don't know if any of the panelists have any views on that.
Yeah, I think some perspective.
I would also just add, you know, valuations overseas are markedly different.
Very different.
So I mean, you know, I'll just pick on one in India. I mean, you have a company in the US with, you know, DraftKings that is, you know, has a comparable peer in India with Dream 11. Dream 11 has better historical growth. It has a longer, you know, a runway of future growth given the demographics. It is profitable while DraftKings is not profitable yet. You know, better revenue, better bottom line, and it trades at 1/3 the valuation of DraftKings. And so when you think about, you know, investing on a global scale, there's just better opportunities at better valuations. And I think the opportunity to bring that to the US institutional community is quite interesting.
Huh. No, I think the point about valuations is well taken. And there's frankly just less money chasing those deals.
Bill, do you guys think that more of a, I mean, what's really interesting about the marketplace right now is that it seems to be a little bit brittle, right? Because I mean, you see Musk's little quote about Bitcoin and Bitcoin crashes. And then there was, you know, the accounting snafu on SPACs, right? And then things really slowed down a little bit. So, you know, do you just think it's the kind of brittle nature of the market that we're in right now? Or do you think, you know, it's an inevitable comeback? Or, I mean, to me, what's interesting is that this tool set for SPAC has just, you know, grown so dramatically over the years of what it can, you know, be used for. And as a result, you know, people are finding more and more purpose for it. So, and obviously we're here in Silicon Valley and there's a great interest in using it for exiting for many of these tech companies.
I think it'll come back. I think it's inevitable. When is always a little uncertain. And we had a hiccup in November and things came back very nicely. But you know, so it will come back. I'm not sure the certainty. Steve and Irv, given their roles, they may be good people to kind of voice when they think it's coming back or how brittle the market currently is.
Irv is the investor, so I'll let him take the first cut. I've got a thesis, but I want to hear what the investor has to say.
Okay.
Look, I think there's a fair amount of supply to shake out. I think if we start seeing deals that trade well again, that are well received by the market, that will certainly be the sign and will lead others to jump in. So I think there is a element of it that's beyond the SPAC market's control, and you know, broader risk markets I think are quite elevated, and the SPACs was just one of the kind of signs of that. So if you share that view, it's going to be a challenging path. If you think that broader risk markets could stabilize and you can have one or two of the higher quality SPACs do some good deals that have a pipe that's well received by, then we could see it come back. You know, I personally, in terms of where I'm waiting to enter, and we might not get this. I think you kind of saw SPACs, let's say, like just to use a dollar price, maybe average SPAC was trading 11.50 to 12-ish, and they went straight back down to call it, you know, high 9s, low 10s for the unit. And they kind of stabilized there for the last few weeks. So we've kind of seen a stabilization, and that's yield buyers like myself coming in for yield plus option. My hope and my view is that you're going to see it widen out 3 to 5% more, where you have like a 5 to 7% discount. And that's really the fat pitch. And that only is going to exist because of the magnitude of supply. You've only seen that before twice in history. In COVID, you got to 5 to 8%, really more 5 to 6% yield to maturity on a 1-year basis. And then during the financial crisis, you got 10 to 12%, but that was a SPAC 1.0, was a different technology. So I think if you have a risk off, given the deluge of supply, you can get to 5 to 7%, and that's when I'd really be waving it in. We're at 1.5% today.
Are you taking meetings, Irv? Are you like would you invest in an IPO like in the next couple of weeks, or?
I mean, it depends who the sponsor is. Like I was looking at one, I won't say the name, it's a guy with a gaming background who I think has a very pristine reputation. He's focused on, you know, kind of like DraftKings, like online gambling. He's an impressive guy, and you could buy his unit around $10. I think that's appealing if you think it's the type of individual with the aura, the marketing ability, the right board, the right theoretical target. So those are the sort of things I'd buy. But, you know, generally, I'm looking at it almost purely technically. And I think a huge portion of the SPAC hedge fund universe is. They'll place a small amount of value on the quality sponsor, right, and a high value on the theoretical yield. And the yield is starting to get there, but we're not there yet.
So the people, to get a little more granular, because I think it's helpful to the group. So the people who walk in, argue, and say, I'm going to put 101.5 in trust rather than 100. Does that pique your interest when you say yield? I mean, how else? What are the specific levers that get you yield?
Yeah, it's yield to maturity. So when you have that, when you have an extension, you get a little bit of a kiss for the extension and you think that's coming, you put that into your calculus. It's just purely mathematical yield. And you know, ironically or practically, those are the lower quality sponsors. So you could kind of have a barbell. Like, there's nothing wrong with finding a great sponsor. You know, one of my biggest positions was Barry Sternlicht #1, which, you know, we made 50% on it with no risk. That was great. And Sternlicht 2 and 3 was harder to get allocations, but those ones did okay too, but not quite as well. So, but that was, at the time, in my opinion, he was the highest quality sponsor I think I'd ever seen in the SPAC universe. You know, you can have different opinions about him, but he, you know, pristine reputation, really smart guy who knows how to execute. So to me, that's really appealing. So those are the situations where I'm going to run after a sponsor, but it gets tough when you got 400 guys out there and you also got kind of high quality guys who are jumping on the bandwagon. So when Barry came with #1, there really wasn't the phenomenon it is today. Like, you can kind of think about like a David Simon, or I'm sure I could think hard and come up with another 5 guys who are really high quality guys, but they're also kind of like me too's.
That's great. That's great. Steve, do you want to add anything?
Yeah, I'll take a more macro, less technical approach. You know, SPACs are new issues, whether they're the IPO or the de-SPAC security, just like a traditional regular way IPO. And in times of market volatility, and in particular market downturns, higher risk return securities, equities, and particularly new issue equities or high vol equities, you know, highly valued biotech or tech names tend to be the first ones to turn off. And I think that's exactly what we're seeing is, you know, we've got, you know, a bit of a bear market right now, and the IPO market is dead, and the SPAC market is dead, and you know, high risk, high valuation tech stocks have been in decline. And so I think when we see you know, a stabilization in the overall equity and fixed income markets, you know, these riskier securities will be your return to being attractive. I you know, I wish I could tell you, I know that's going to be next week or next month. I don't know when that is, but that's my thesis on the market overall.
Hey, Steve, do you see the valuation or the decline in tech companies as a result of inflation or interest rates?
You know, I think I would say, Marty, I see it as a market reaction to the perceived risk of inflation. You know, I don't think that Facebook is down because, you know, the chances of their earnings going down or the value of their earnings going down, you know, is a reason for the decline in the stock. I think it's that I think is more technical, where I think that economically sensitive, meaning cyclical companies, are going to have your very, very material uptick in earnings this year. And so, you know, think manufacturers, think, you know, consumer focused companies that are deeply cyclical, travel companies, et cetera. Their earnings are going to explode. And so I think people have tended to rotate out of you know, the FANG stocks and other highly valued equities to buy cheaper earnings, where you're going to see a lot of growth this year.
Fantastic. Bill, any more questions?
No, I think we're out of time. We could go on for another hour if you want, Marty.
Well, I need you for 5 more minutes, Bill, because I'm still waiting for my venture capital panel to come in.
Oh yeah, we got that. No, we've got. Yeah, I think. I guess a little bit along the same lines we were discussing. Another question that I get particularly lately is: are there too many SPACs? And I know my thought on this, but I'll let someone else go first. You know, Steve, what do you think? We'll go from Steve, Chris, Irv, and Eric. Are there too many SPACs? I personally don't think there necessarily are, but I'll give my detailed answer afterwards.
Yeah, I think there are too many SPACs, but more importantly than too many SPACs, I think there are too many tourists in the business. I think there are people who looked at this and said, hey, good risk return trade-off. I don't really know what I'm doing. I don't really have a lot of value add, but I've got somebody to back me and coming up with the risk equity, and why not take a swing at it? So, I think that your professional, high quality, institutionalized sponsors, you pick your flavor of those, will do fine. I think that as I say, that tourists in the SPAC business are going to be challenged.
Yeah, I agree. I agree with you. Chris, have you come to the conclusion there's too many SPACs or?
I don't disagree with those comments. I would add maybe two things. One is, I think there's probably too many all focused on, the same kind of general consumer growth space. So I think there's probably not enough differentiation amongst some of them. And I get it, right? They write their prospectus broad enough so that they can get a deal done, but narrow enough to say, hey, I have a skill set. And somehow it all kind of looks like it's consumer. So just say maybe broad, I'd love to see a bit more broad exposure to other areas. But the other way I guess I look at it is, it's also a function of how much, supply is out there, and that supply of private companies looking to go public for their next, their next leg of growth. I think the supply still far outweighs the demand, and demand being the SPAC from the SPAC sponsors. So, it's not just the amount of sponsors. I think it's also the amount of supply.
You had a very good point in our prep call on this, Chris. I thought where you said, I think, and you'll be able to characterize much better than I was, and elaborate. But basically, when you look back at the companies that got funded in the last 7 or 8 years, and the money that was deployed, there are plenty, like you say, there are plenty of companies looking to monetize now.
Yep.
That should be developed, right?
Yeah, I mean, the pushback we got initially is everyone points to the latest article in the Journal or Bloomberg that says there's X, more SPAC dollars raised this quarter than last quarter, or this year than last year. And we just feel that's the wrong comparison. All that's saying is, demand last year versus demand this year. And so we said, let's look at the actual supply. And so we said, okay, well, what does supply look like today? And those are private companies that have built enterprise value, and need some liquidity. So we say, okay, well, who needs liquidity now? And it's effectively all the deal flow and dry powder that got put to work 3, 4, 5, 6 years ago that has now matured into blossoming businesses. And so if you look at dry powder that got deployed in either private equity, venture, loosely defined as real assets, and aggregate that supply up in 2015, 16, 17, 18, the numbers are astounding, and still magnitudes the amount of how much demand is there from current SPAC sponsor capital. So we think
that's a great point. That's a great point. And what I tell people on this point in my own is, if you, kind of like Steve alluded to as well, if you have real deal flow, you should, there's still an avenue to be successful with the SPAC, because like Steve said, there's a lot of people in it that maybe don't have the deal flow and the wherewithal to really go find a good deal.
And that's why I think some of these like SEC rules and other things that are viewed as hindrances, they'll wash out some of what Steve refers to as tourists. So to the extent that it, maybe it decreases the number of SPACs, but increases the average quality. I think that a lot of people in the SPAC world welcome these speed bumps, if you will, to rationalize that. And in our case, we think that if there are too many SPACs, they're arguably at the higher valuations, and that SPACs can be a useful tool at the more moderate valuations.
It's a good. Yeah, no, I agree. I think people are all on the same page.
Hey, Bill, I just have and I think you guys might have addressed it already, but I just have a final question here, and then we got to break to the other group. But so I had a conversation, it must have been 5 or 6 years ago, and I was in Europe and I was talking to one of my cousins, the lawyer there, and I think you might even know her. You know, I was telling her about SPACs, and she said such a thing would never happen in France, right? Do you think that, you know, places, other countries like Europe and Asia see how robust the market has been, and that they're all saying, well, maybe we should take a second look at this? Do you think that as much as the market here has slowed a little bit, do you think that the other, and I know you kind of addressed this sort of in the other questions that you answered, but do you think that people are looking from a regulatory perspective in other places, loosening up their markets to make, you know, these things possible? So the question is regulatory, you know, not, I know you do a lot of international deals.
Yeah, well. I mean, my view is that, look, the AIM years ago did a few, and they just didn't have the liquidity to support it. I am sure, and I've heard the LSEs, I'm sure European stock exchanges are looking at this, but and trying to, you know, get it under their umbrella. I know Milan has done a few, but it's not just up to the exchange. Then you've got to have a bunch of people willing to invest a whole lot of money on these deals. You know, I think that's what they, and so I don't know. I'm sure exchanges are looking at setting it up, but then there's other things that have to come into play to make it feasible and viable. You already have a dynamic where a lot of foreign listed companies come and list in the US dual list. So I'm not sure at the end of the day, companies won't end up listed in the US, even if these got going on other exchanges, which to my knowledge, they really have. Yeah,
I think in the future, we're going to address this whole, you know, ASX thing that people are, has become kind of a hot topic in the fintech world, and doing these joint lists, these cross listings in the US from Australia. So any other thoughts on, you know, regulatory environments outside the US, or?
Not for me. I don't know if the guys have anything. Chris, Steve, Irv, Eric.
Nothing here.
Well, guys, listen, you have always been fantastic panelists, but you're very good today. And so thank you so much for your participation. And I know that I have, you know, tons of people are saying, can I exit in this SPAC? So always great to hear from you. And we look forward to your further participation. So thanks so much.
Thanks. Thank you very much.